Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Welcome to another episode of the Retiring Real Estate Investor Podcast. I am your co-host, Brandon Bruckman. We've given our other co-host, Josh Wright, the day off. Lucky for Josh, he's not with us, but we do have a special guest today. We have Boone Dupree is the CEO of NewStar Exchange. Boone, thanks for joining us.
Yeah, Brendan, happy to be here.
And Boone, as we talked about before the podcast, that is not a virtual background, everyone. That is a real office in a real city that Boone is in. Boone, where are you joining us from today?
I'm down here in Atlanta, and we are live and in living color in the office.
Wow, remarkable. I like it. I like it to have the team back. So give us a little bit, Boone, share with our listeners a little bit about your background and about NewStar.
Yeah, sure. So NewStar is we just celebrated our first anniversary. NewStar Asset Management is the mothership. It's the holding company. NewStar Exchange is our DST sponsor subsidiary business. So we started NewStar a year ago, spinning out some executives from a REIT called Preferred Apartment Communities that was just acquired by Blackstone. Really successful background there. We had IPO'd in 2011. We focused on multifamily investing as our primary strategy. We had two commercial kind of sub-strategies there. And we kind of pioneered a hybrid listed, non-listed capitalization strategy. So we had a common stock that was initially IPO'd on the Amex and then ultimately traded on the New York Stock Exchange. But we supplemented that equity capital raise with a non-listed preferred stock. And that was really, to our knowledge, we were the first listed REIT that was also raising through a broker dealer in the IBD channel. So it was highly successful. We sold just under 2.8 billion or issued about 2.8 billion in non-listed preferred shares or dollar value. And through the sale to Blackstone, we sold the company for 5.8 billion. We paid every preferred dividend we owed on time the whole way through. It was a 6% coupon. And for our common stockholders, we returned 3.3x multiple on their money. So it was great. It was exciting to be a part of something new and different. And as we were looking at spinning out and starting NewStar, we wanted to utilize some of the features that we had developed at PAC, and really, namely, that was the broker dealer built by our founder there. Which is Preferred Capital Securities. And so, what led us to the exchange business was, one, just demographics. We have a really quickly aging baby boomer population. 17 to 19 million Americans are entering retirement age through 2030. It's 4 times, 5 times a bigger category of the population than the next, which is the family formation crowd. So one was just demographics for exchanges, where you have a big group of Americans that own and manage property and may be looking to, turn that into something more passive. And then the other, a little bit more by necessity, the market just moved. Cap rates for multifamily properties continue to get tighter. We were successful selling a 6% dividend, but when you're buying at a 3.5 cap and you're financing it, 4 or now 5+%, you can't cover that dividend. So that kind of led us to the exchange business, and it takes some time to kind of carve out your niche in the market. And we've been through that before. The first year at PAC, selling our non-listed preferred stock, we raised $8 million, I believe, in the first 12 months. And at our peak in 2019, we raised $561 million. So, it's just, it takes a bit of time to build a brand. Fortunately, we're coming into it, with the existing kind of distribution network and experience, seeing how it all kind of comes together.
Mm-hmm. Mm-hmm. Yeah, it is. Thank you for describing or sharing the background. It is not easy to be, in our experience, a new sponsor in the space at all. We have a list of experienced sponsors, but we also believe there's a great desire in the marketplace for new sponsors and new products. Talk a little bit about that niche that you're trying to sort of carve out in the space.
Yeah. So our focus, markets move, but our focus right now is on single family rental, and more specifically, it's build to rent. So really, that's just single family subdivisions that were designed, entitled, developed, and leased for rent, as opposed to being for sale. And there's a few reasons we like that. One is really simple. It's just back to the demographics. 100% of millennials will turn 30 by 2026. So this huge wave of population that's been driving urban apartment demand is now getting married, having kids. I'm right in the thick of it. We're due with our first child here in a month. And,
oh, wow.
And we're seeing our friends do it. Friends who said they'd never move to the burbs, they are moving to the burbs. So you have that, and that's a huge driver, and the preference is just shifting from, I want to be walkable to everything, and I want to be able to go out on the weekends, to, that's secondary. I want a yard, and I want a safe neighborhood, and I want a good school, and I want space for my family. So the first, that's just really simple. Kind of compounding that is this for sale housing affordability, really a kind of a crisis we're in. We saw a study from Harvard a few months ago that said 92% of renters today couldn't qualify for a mortgage on the median price U.S. home. So that's a big problem. It's only gotten worse since that analysis came out. That was in April. Everyone probably has an anecdote. I think the median mortgage rate's over 6%, but plenty of people can't even get that. So our focus is on these purpose-built communities, getting more space. Our typical unit size is about 1,500 feet. It's 3 and 4 bedroom homes. We'll look at attached product. We'll look at detached product. It's all new construction, new vintage product. We're not doing SFR. Single family rental comprises build to rent, where we're focused, which are these communities built together, and then also scattered site. And scattered site would be more akin to what American Home for Rent or Invitation Homes, Waypoint Homes. Some of these groups have done aggregating, one by one. And there's a place for that, but you have to have huge scale to make it make sense operationally. It's just a lot of work. Whereas buying buildings where you have 50, 75, 100 homes together, you're really managing it no different than we managed our apartment communities at PAC. In fact, the margins are better. The deals we own today are right around 70% operating profit margin. So our expenses are only about 30% of our revenues. We're able to manage these communities remotely. We don't need people on site, because the psychology, we've observed the psychology to be different. You have an apartment renter who feels like they're a renter. And so if they have a light bulb go out, they call in a maintenance request. Really, anything they need, they're going to call it in. When you have a home, the psychology is ownership, whether they're paying their mortgage or they're paying rent. I don't think the psychology is really different. We get far fewer maintenance requests. We have to tell people not to mow their lawn. We're like, we'll do it. You don't have to get out there. Um, so the margins are good. Depending on the research provider you go to, the rent growth forecasts are considerably higher than multifamily rent growth going forward. Again, just because this demographic push and people are being forced into renting. There's a severe shortage of housing. It's been well documented on the multifamily side and kind of used as justification to continue to build. But if you kind of break down the supply deficit, it's like 75% of that deficit is attributable to single family. So it's much more acute there. And then lastly, we're in our development subsidiary, we're also developing this stuff, and it's getting harder and harder to get entitlements to do single family rental. If you think about it, whereas multifamily's been more focused in urban locations, single family rental, it just requires more land. So you get pushed to more suburban areas. That's also where people, tend to go to raise their families. But those are also the neighborhoods that are most prone to, pushing back. Rental is not always totally welcome. And so entitlements are getting a lot harder. We've seen here in Georgia, one of the northern suburbs, just went back in and rewrote their whole single family zoning code to put a rental restriction on it. And so if you own single family rental that was developed prior to that adjustment, you just overnight got a value pop because it's a lot harder to come in and build competitive product. So, so that's what we're focused on.
Well, let's unpack a few of that so our listeners can understand a little bit more about the single family, the built to rent sort of space. Help us understand, maybe from a market perspective, what are the dynamics that you're seeing? I mean, is this something that works in all markets, or is the gap that we see, as I think everyone is seeing at the national level, we have a shortage in housing stock, right? Okay. So where is that occurring, right? And so is that where your process starts in figuring out, okay, what markets make the most sense for this product to be located in? Do some markets not make sense?
Probably. Our entire careers, really, by luck or coincidence or otherwise, have been in the Sun Belt. So Sun Belt being really kind of Carolinas down through Florida, across through Texas, and really in Arizona. Within our team, we have, just sort of aggregating our collective experience of the executive team, 10 million feet of commercial property owned and acquired in those markets, 10,000 residential units. Everything we did at PAC was Sun Belt. So, fortunately, the Sun Belt has just been a big winner. It had been for some time. Again, just because we don't have geographic barriers, there's room. Last cycle, 15 years ago, the growth was being driven by these suburban, for sale communities, and then that kind of blew up. But we have room to accommodate growth, and the cost of living's been lower, and all these things that are well documented and everyone's heard before. COVID was no fun for anyone, but it was a major driver. Or really accelerant for the growth in the Sun Belt. And it just was rocket fuel. And so, again, we're lucky to be here, but it makes it really easy for us to kind of stay focused within our strategy. In terms of geography, we just continue doing what we've been doing. And closest to home here, Raleigh, Charlotte, Nashville, Atlanta, Florida, all the Florida markets. We pay attention to Texas. Historically, we've done quite a bit out there. I think we'll get there as we grow our team. Texas is a market that really needs to be run locally. It's harder for us to cover with day trips. When we're ready, I think we'll put somebody out there. But yeah, and within those within the Carolinas, Tennessee, Florida, Georgia, as our kind of primary markets, you know, we're looking at the top performing suburbs. And again, at PAC, that was something our founder, John Williams, who had started Post Properties and took Post public and then merged them with MAA. From the start, he was focused and committed to first ring, top performing suburbs. He never brought our focus in urban. And I think that the world has moved that way. And that's where we're continuing to focus.
Gotcha. So I'm hearing it's a combination of, yes, we found really great markets, but there's also markets we know a lot about from our prior experience. We're here, we're home here. We understand those markets. And yeah, oh, by the way, we've gotten really helpful that these markets have grown so much from a demographic perspective through COVID that it just makes it prime opportunity for the built to rent sort of setup to work. How much, you mentioned that built to rent the rental rates are expected to grow faster than, say, multifamily. What does that trajectory look like?
It depends on the market, but we pulled our primary Sunbelt major markets in the last 2 months. And I can't remember exactly what was on it, but I want to say it was like 6 to 8 cities in the Southeast. It was like Orlando, Tampa, Atlanta, Raleigh, Charlotte, Nashville, something like that. And the 5-year average rent growth forecast was between 5 and 6% across all those markets. So, that's well above historical averages. And then on the multifamily side, we looked at it too. I mean, we're not above. We've invested quite a bit in multifamily. Historically, it's a great asset class, but and the outlook is pretty solid. 2.5 to 3% annual rent growth. But when you look at that, the difference in a 2x difference in your rent forecast, not only is that benefiting you along the way in your operating cash flow, but you've had a cumulative effect of 10 to 15% more growth in your top line over a 5-year hold, and you put a cap rate on that in year 5. It's I think one thing that gets a little bit lost in the shuffle on these DSTs is there's so much emphasis put on the initial yield, and that's just a single static metric. We could go find yield in a GSA deal that has no rent growth in the lease. You just have to kind of consider where you start, what happens along the way, and where you finish.
It's a really good point. So when you think about this asset class compared to, say, multifamily, I'm guessing that the cap rates upon acquisition are somewhat similar. Is that correct?
Well, you would think. I mean, you would think that if you had a better growth outlook, you would pay a lower cap rate. And because there's so much capital that's been organized around multifamily investing, and we're still so early in the single family rental kind of evolution, cap rates for multifamily are still well inside of what we can pay for a single family rental community or a build to rent community. The other thing we're doing is we're focused on, under 100 homes. So targeting ideally 50 to 100 homes at that scale. They're big enough deals that they can operate efficiently, particularly when we utilize remote management. But they're small enough that it's not on everybody's radar. And that's where being local is so important, because a lot of these are guys, I mean, almost in every case, the first 2 deals we bought, both were off market. Almost in every case, the deals we're looking at are coming from local or regional home builders that had been building for sale product and have pivoted because they've heard that, there's a viable, effectively, think about it from their perspective. Historically, you either do a retail sellout, meaning you sell homes one by one to the end user, or you do a wholesale sellout at a big discount to somebody who's then going to go sell at retail. Now what we're telling you is you can do a wholesale, meaning one closing, bulk sale, and you can get a better price on a rental basis than you can on a for sale basis. So we're seeing a lot of that. And, for 50 homes at a time, I'd say a cap rate, but cap rates just keep moving because the Fed keeps walking.
Yeah.
But, before this last meeting on Wednesday, as of early September, you know, Class A suburban multifamily is not trading at quite the same velocity, but still trading at a mid four cap, I'd say, in the Sun Belt, and we're buying low to mid five cap, and our growth outlook's better.
Yeah, that's exactly where I was going. As you kind of wrapped it up, there was here we have an asset that has projected better growth in the NOI line at I'm buying at a higher cap rate than I am at multifamily, and you laid the factors out perfectly. This sort of institutionalization of the multifamily asset, especially the Class A asset, has just driven these cap rates to levels where, you know, as our investors are looking at DSTs and we're doing the homework beyond year one cash flow. Also a great point you made. Too much emphasis on year one cash flow. When we look at that as a total IRR basis, we're struggling to pencil that out. We need cap rate regression, or we need cap rate compression to return capital to investors in some of these deals. And it's not a winning proposition. So, I mean, what you're telling me here is that it's favorable in the investor's perspective, because we may not have to pencil out cap rates that are gonna squeeze in tighter. We have some room here because you're getting growth.
Yeah, and that's true. It's interesting. We had a team meeting this morning, and we, you know, just sort of whining about, you know, interest rates, and you know, we've just been on this wild ride where interest rates are being supported. You know, interest rates keep going down, cap rates keep going down. Everybody makes money, everything works, and the reality is you need there to be losers for there to be winners. And so what we're going through right now isn't the worst thing. It's going to shake things out, and there's going to be opportunity from it. And among those opportunities, you know, for the last 5 years, we've underwritten between 50 and 100 basis points of cap rate expansion on our exit, because we just can't. It just makes no sense logically that, you know, going in at a 4, you're going to exit at 3.5. It just doesn't seem sustainable. But, you know, we're headed towards, you know, we're now underwriting BTR deals at 6 cap stabilized. Time will tell if you know, there's willing sellers at that pricing. But if you look at where the Fed's dot plot is taking interest rates, I mean, we got to start taking them seriously for what they're saying. And I think a 6 cap is really kind of a threshold right now. But if you're buying it at 6, all of a sudden it's not that crazy to think you may actually get some compression on the back end. Feels a lot better expecting that coming off a 6 than coming off a 3.5.
100%. Couldn't agree more. And it's funny the way we've watched some of the underwriting change from third parties in this space as we've seen these deals get tighter and tighter. That 100 basis point modeling turned to 50. Yeah. Like, whoa, wait a second. Like, I noticed a little difference here, right? And it isn't fair to do. And we're 100% with you on that. We've talked a little bit about, to pivot you a bit, about the DST space, your new entrance to that space. Anything that's been surprising or challenging about entering that space in terms of maybe deal construction, or frankly, even explaining some of the asset class to investors?
Yeah, I mean, if there's somebody,
I feel like I'm unpacking pain points here.
If anyone's ever listening in on this thing, contemplating starting a DST sponsor, I would tell you, don't do it. No, I mean, we started looking at. In fact, when we were at PAC, I pitched, and our broker dealer pitched our founder on adding a DST business kind of in tandem with our REIT, similar to what Black Creek and JLL and others have done for the investor, having the brand and kind of the credit backing of a big public company, and then ultimately having kind of a way to do a tax deferred asset swap, and then a 721 from the asset into the OP units. You know, it's a great way for an investor to go tax deferred, you know, active to passive, and then passive to really passive with a diversified portfolio and liquidity through a REIT stock. And they just didn't. We were just focused on on kind of the bread and butter and building the REIT, and it never took off. But so it's really been probably 3 years now that we've been researching the space. It's a pretty clubby market. I mean, there's like a handful of tax attorneys that are the specialists, and then there's really a handful of DST sponsors that are driving the vast majority of the business. So to us, that felt like an opportunity, to come in and carve out a position, and then also, when we were starting, or when our founder started back in 2011. The thesis was to ride this, the median millennial age was 22 or 23. And it was just, we were historically undersupplied on multifamily units right at the time that our population needed them most. And so, he went all in on that and rode it for a decade, and it worked great. And the one thing we know is that markets move, and you got to be ready to kind of reinvent yourself. And so, it's by no great genius that, we just said, oh, millennials were 23, now they're 33. Like, what did they need then? What do they need now? And nobody else, to our knowledge, is, Sunbelt based, BTR focused in the DST space. So, it's really that simple.
Yeah. And funny, but interesting things there to kind of take away from that is, especially for our investors listening, there's always a conversation that we're having about fees and fee structure, and rightfully so. And we should talk about it and be transparent about it. And that's great, but it's good for it's good for everyone to hear the understanding of starting in this space is not easy. It's hard from the sponsor perspective to start here and gain traction and make putting and formulating these deals, frankly, worthwhile, because there's a lot of different avenues that you can walk down and proceed to raise capital. Right. And this is a harder one. But once you make a good footing in the space, it can be a very efficient way to sort of raise capital. But it takes a minute to kind of wedge your way in. And it's funny, it's a lot of ways your story is similar to ours on our side of the fence in this sort of game that we're playing, in that we saw opportunity as well. We spent a considerable amount of time, researching this space too, and are still of the belief that the space is vastly too small, considering how much opportunity there would be available for it, by the tune of, I don't know, maybe we can double. If we doubled inside of, a few years, I wouldn't be one bit surprised. But that's going to take bringing new sponsors to the space. There's been the same level of, practically the same level of sponsors in the space for the past, 5 years, while the volume has gone up, as you probably know, tremendously. Yeah. So it's a matter of, it is a matter of breaking some of the old, I'll call it the old boys club. If we can kind of break free of that network a little bit and expand, I think it's all the better for investors. There's definitely every folks we talk to every day aren't aware of this solution, but man, do they need it from an investor perspective to frankly do what they want to do in their life. So yeah, no, I think we're glad you're here. Don't leave yet.
No, I think you're right. I mean, it applies on your side and on my side. We have a differentiated product, and that story really, that's what we lead with, because, to me, there's a lot of multifamily offerings out there, and for the most part, it's following yield. So it's going more tertiary. You have experienced sponsors who've round tripped a bunch of deals, and that's great, and they've performed. But otherwise, it's a lot of, it's a little homogenous. And so the market needs different products. That's why we lean on the BTR. We're big believers in it. We're putting our own money behind it. But the other thing is, you're right. I mean, the new guys always got to work twice as hard. I can promise you there is nobody. I was just telling our guys this morning, there is no DST sponsor on the planet that is scrutinizing, $500 landscape bills like we are right now. It's by necessity. And maybe as an investor, you don't allocate 100% of your cash and QI to the new guy. But if it's me, I'm going with somebody who's hungry. You gotta shoulder your way into some market share here.
Yeah, 100%. We know how you feel. sort of the same way from our desk. And I do think that's really important for investors to think about. There's an opportunity here with the way the DSTs are structured to really build the quintessential diversified portfolio across asset classes for sure, but also across sponsors. And it's something we encourage our investors to really think about. When you're able to really break things up into 100K increments, if you really wanted to, your opportunities are endless. You can build your own REIT, more or less. So take advantage of that. And the only way to do that is you can't have, we're not going to advise people to do 7 different multifamily deals. That's not diversification. That's the same thing over and over again. So they need to look to other spaces. So we're glad you're here, and the traction will continue. What's some of the things that you see, maybe not just in this space, but across all sponsors and investors? What are some of the things that they're missing about maybe making some of these investments or managing some of the properties, or maybe some of the assumptions you mentioned before? What are some of the things that sponsors and investors are most commonly missing in your point of view?
I don't know. I mean, I'd come back to the initial yield as being just one part of the equation. Again, that you can have a nice yield, and then it could be a net lease property in the middle of nowhere that when the lease burns out, your asset value is zero. I mean, there's a, I think it was John Gray, one of the Blackstone guys, has commented before that the worst thing about net lease is that every day you wake up and it's worth less. And that's not necessarily always the case if you have high quality underlying land. But a lot of times it is. So I think you just got to get the whole story. I mean, what are you going in at? What's your supply demand story while you're holding it? Are you going to be able to push rents and keep your vacancy rate down? And then, on the back end, is there going to be more liquidity when you're selling than when you bought? And if there is, you're probably going to get a better multiple. So, for us on the BTR side, it's pretty astonishing. In the last 2.5 years, there have been about $40 billion of institutional joint ventures announced to go pursue single-family rental strategies. And that seems like a lot, but the entire single-family rental market in the U.S. is only 2% owned by institutions today. And if you compare that to multifamily's 50 to 55% institutionally owned. So, like MetLife did a white paper on this, and to go from 2% institutional ownership just to 10% would require $300 billion of incremental capital flows to the sector. To go from 2 to 50 would require $2 trillion of capital flows. So, that's what is so interesting to us about this. 10, 15 years ago, multifamily was in the same position. The demographic story was lined up right in front of you. Millennials were in their 20s. The asset class really hadn't been institutionalized. Historically, the main food groups for institutional investors and public REITs were office and retail. We went through this major transformation over the last 10, 15 years. Multifamily sales volume from the early 2000s to the 2010s increased 6 to 7x. And it's by no mistake that over that same period, cap rates got cut in half, multiples doubled. And so that's what we say is like, really we would pay a lower cap rate for build to rent than multifamily because the growth's better and the exit's going to be better. But right now, when we can pay a higher cap rate and get the growth and the exit, but you got to look at all 3 legs of that stool.
Yeah, keeping a spot in front of institutional and be waiting when they're ready to allocate and swing that hammer your way is probably not a bad place to be. And it is interesting in talking to your point of view of the total return that we're talking about. It is a tough concept for our investors to think about. It's not something that they're used to, or they're more used to scrutinizing the $500 maintenance bill or lawn bill that you mentioned. They're more akin to do that than thinking about total returns or even thinking about deploying of capital and cash on cash. These aren't things that they're thinking about on a daily basis. It's really incumbent upon us to say, okay, let's make the shift. You were a property manager before. Now you're more like an endowment fund manager or a pension fund manager, which is a scary thing for me to say to say to the average real estate investor is like, you got to kind of shift your mindset and think about, all right, if we're planning on keeping this money for multiple generations, how are we the best stewards of it? And that's going to require us thinking about full cycle returns in some of these things and learning some of these concepts and understanding the drivers associated with them. There's a lack of, from our seat, there's a lack of education there. So if we can kind of take them along that journey, then I think it matches up with, frankly, what makes sense for us in being stewards of the money, but also it rhymes a lot with what you're saying about total returns.
Yep. Well, we've seen what happens when you lose track of the valuation of your asset. I mean, the first generation of non-traded REITs, that's why we went through this whole evolution of fair market value. And I mean, your NOI is just one number. If your cap rate gaps out 200 bips, you're going to lose money.
Yeah, it's that simple, and it's sort of a lost cause for us on some of these concepts. So we're taking folks through that educational journey as well, and trying to appeal to them beyond that first year capital. This is great. Thank you so much for sharing all this with us and kind of the journey that you're going on, sharing some more about this built to rent asset class that I don't think a lot of folks are familiar with yet, but the story is compelling. It's there for folks. The demographics make sense. Housing's not going to become more affordable anytime soon. We've been struggling since the last major recession in this country to build enough housing for folks. That doesn't sound like it's going to change anytime soon. So it sounds like this opportunity is going to be around with us for a while.
Yeah, we think so.
Where can folks, you can always come to, so for our investors listening, you can always come to Insight to talk about any of these opportunities, but where can folks learn more about you and NewStar?
Yeah, our website's newstar-am.com, and you can click through there and find our NewStar Exchange page. And again, we're newish to the space and continuing to sort of get more of the things we just talked about on this call published more broadly, so people understand there are these options out there and they understand how we look at the world, and so over time we'll continue to kind of get that out there. But you can go to our website.
That's awesome. We'll add that in the show notes, and I want to include a couple of the white papers that you mentioned as well, so folks can learn a little bit more about. And we do have a handful of our investors do want to dive deeper. They read entire PPMs. Sometimes even the great ones point out mistakes in PPMs that sponsors have made. So I know they're really paying attention. So I want to link those in the show notes as well, so folks can read those as well as find you guys. So we'll link those up. But hey, Boone, thank you so much for joining us. I really appreciate it.
Yeah, thanks, Brandon.
All right. Thanks for listening, everyone. Take care.